Accounts receivables are an important current asset which provides a strong indication of a business's future cash flows and therefore should be considered by any stakeholder when analysing a business and its profitability. The main ways that any investor, creditor, or manager can analyse accounts receivable is through horizontal and vertical analysis, the receivables turnover ratio, the days in receivables ratio, and finally the allowance ratio. Firstly, horizontal analysis of receivables allows for analysis over time and is useful in identifying positive or negative trends in a company. This ratio calculates the dollar change in the receivables balance by minusing the current year by the prior year and then dividing this by the prior year balance. For example, the receivables in this instance has increased by 22.78%, showing strong growth for the business. Vertical analysis compares the accounts receivable balance within the year by dividing the accounts receivable amount on the balance sheet by total assets. For example, 128,740 divided by 872,605 is equal to 14.75%, meaning that 14.75% of the business's total assets are accounts receivables, which is a strong financial position. The receivables turnover ratio is a measure of a company's ability to generate and then collect their receivables by comparing credit sales to average receivables. For example, this shows that it takes 2.8 periods for the business to collect receivables. However, this ratio can be misleading as the lower the number of periods, the longer it takes to physically collect the receivables. The days in receivables ratio expresses the receivables turnover ratio in days by dividing 365 by the ratio. For example, a receivables turnover ratio of 2.8 will mean that the business takes 130 days to collect its receivables, which is a relatively long time. Finally, the allowance ratio measures the percentage of receivables that are expected to be uncollectible in the future and is found by dividing the average for doubtful debt by gross receivables. The example shows that it is estimated that 20% of accounts receivables will be uncollected, which depicts that the business needs to reconsider who they are selling their accounts receivables to.